Hello everybody, it's Chuck Carnevale, co-founder of FastGraph's Fundamentals Analyzer software tool and one of the co-founders of the Dividend Kings marketplace service on Seeking Alpha. I'm going to do something a little different here, kind of offer a little different fare than I've been traditionally offering here on my recent video. Actually, I've had several requests to cover some high growth stocks. Typically, I write for about what I would call more recognizable, more perhaps conservative or prudent dividend growth stocks like Dividend Kings and Dividend Aristocrats. And frankly, I've even been criticized in some comment threads that since I'm a grandpa, I don't know about growth. Well, I've been a growth investor most of my career. And, we own some really terrific growth stocks like Cisco and Microsoft and Cognizant Technologies and Visa and Apple, of course, and we've made a great deal of money in those over the years. Now, as I have gotten a little more mature, I obviously have tended to move my focus a little bit to dividend growth investing, but I still like a good growth story. And so what I've done, I've had several requests to cover some high growth stocks. And I had one subscriber and reader and viewer in particular actually give me a list of some stocks to look at. So I've got some other areas that I may be doing more of these in the future, but today I'm going to cover four kind of interesting looking, what I would call growth-oriented stocks. Three of them I would call small caps. If you look at them from a standpoint of their market cap, you'll discover that only one of them, Discover Financial Services, the Discover card, has actually a market cap in the billions. It has a market cap of 14 billion. The other three are measured in millions. Well, actually, NMI Holdings, which is a property and casualty insurer, does have a market cap of just over $1 billion. But the other two, 533 million for Boot Barn, which is obviously boots, retail trade, and then Advanced Emission Solutions has a market cap of about 138 million. But these are very, very interesting companies, and I thought you might find them interesting to look at. For convenience, I'm going to do these in alphabetic order. I'm going to start by looking at Advanced Emission Solutions. This company, it's really about emissions, cleaning up emissions, especially for the coal industry. Also, they do quite a bit of work with water purification in the water, the municipal water supplies, etc. But what's interesting about this stock, they've been around for a long time. And if you look here at their long-term record, you can see that their earnings growth rates were very spotty. I'm going to take this normal PE off the graph so you get a little better perspective. And the stock price really hasn't done anything in this entire history, but it's only since really, I'm going to say 2015, that the company started making any money, and they made a lot of money in 2016. I'm not actually sure why. That might be something you might want to look at, but I'm going to drop this graph down to a 4-year graph and just look at what I'm going to call more modern earnings season here. Now, in 2018, their earnings grew by 36%. And then 2019 by just 10%. That's this right here. You can see it flattened. It was higher here. But it's forecast to grow by 60% this year, 61%, and then 40% the next year. Now, the bad news about that is there's only one analyst making those forecasts. But I do want you to notice that these forecasts have also come down. The most recent estimate is obviously $1.93, which is what we're currently showing for 2019. 3 months ago, that was $2.34, and 6 months ago, it was almost $3. So the estimates have come down. The company is estimated to earn $3.20 in 2020. That's come down from $4 and $4.81 3 and 6 months ago. But with that said, this company is still forecast to have a very strong growth rate. Now, the bad news, because of this company's, I think, long-term spotty record, the market's never really given them what I would consider even a reasonable PE ratio. So I'm going to look at their historical norm again here, and I'm going to put the normal PE on the graph. And I want you to notice it's been about 6 times earnings is all this company's trading at, and it's currently only trading at around 3 times earnings. And yet you've got all this earnings growth, and then you've also got a dividend record. The company only has 14% debt. They never got a credit rating, so we don't have a credit rating. And again, it's a very interesting company relative to the growth potential, but it's not really performed at all historically, which is what I would consider to be one of the big risks. But if this company were just to go back to a normal 6 times earnings, this is a 6.31 PE is what I'm drawing this blue line, then the rates of return for the next couple of years could be extraordinary. So one of the great advantages of fast graphs is to help determine whether a stock is research worthy or not. This stock looks like it has all the attributes that would make it research worthy. Now, it's a dividend payer, so from that point of view, I also want to take a look at operating cash flow. And here, the record for operating cash flow is actually pretty good since the time that they've been paying a dividend. Now, they've only been paying a dividend, as I mentioned, for a couple of years here. So, this isn't a real consistent story. It looks like it's an evolving story. Obviously, emission control is something that's on everybody's minds here. This company does some really interesting work in that regard. And, real quickly, I want to just go into their corporate website for you. And you can see that the company does carbon-based solutions for cleaning up like coal-driven plants. They work with municipal water cleanup and so on and so forth. So kind of an interesting stock. I don't know a lot about it, but it might be one that you might want to take a closer look at. So it's certainly got a lot of possibilities. It's certainly cheap enough, and it is expected to grow rather dramatically in the future. The next company I want to take a quick look at is BURL, and this is really purely a growth stock. Again, I'll go real quickly into the company's website because these are not stocks that I've done a lot of work on. But these guys, they sell boots. It's a retail company. They sell work boots, men's boots, women boots. They have these various clothing brands that they sell, blue jeans, etc. So it's just a really basic retailer. However, the company has put together a pretty consistent record. You can see after their IPO, they had a real strong rally here. They got significantly overvalued. This is a PE ratio of 16.4 driven by this orange line and a PE ratio of 20 by the blue line. So you can say that historically, with a few exceptions, the stock has traded somewhere between, we'll say, 15 and 20 times earnings. You can currently buy it at a blended PE of 11 times earnings with an 8% earnings yield. The company has 39% debt, which is modest in my opinion. Again, it's a small cap, 533 million market cap stock. And you can see that as a result of the pandemic we're going through here, the company has had a tremendous drop. But it was also a very well followed, well-liked company where it was trading at a PE of almost 28 in December of this year. And then, of course, from there, from peak to trough, it fell by almost 71%. And then it's been rallying quite strongly. They are expected to have a down year this year. And when you look at forecasting going forward, and if you apply a normal PE here, I've got a normal PE of 19, which is close to that 20 I talked about. It would be a very attractive investment if it got back to that PE. If I go back to a more conservative PE of 15 PE, the rates of return don't look so good this year, but by the end of next year, they start to get double digits, 17, 18% again. So again, a very interesting company. It doesn't pay a dividend. I'm not going to worry too much about cash flows. This is an earnings story, and it looks very attractive on that basis. The next growth story, if you will, I'm going to look at is Discover. Now, I want you to notice something about Discover. If I take my scroll bar here and get rid of the COVID, which is obviously a big issue here, and look at this company from a long-term growth rate, if I even go past the Great Recession and look at it just coming out of the Great Recession, the company's grown just impressively fast at over 60% a year. But let me also get rid of a couple of anomalous numbers. So it's been, we'll call it a 10.5%, 11% grower. If I look at forecasting going forward, it is expected, because of its retail exposure to have a very bad year this year, but then it's expected to grow significantly by 2021. And then once again, on to 2022, we have some really great growth. So this company gets back to even a 15 PE ratio. Rates of return going forward could be very, very strong. Because it's a credit card company, debt is kind of their product, so I don't really get a debt level on the stock. But I do believe the stock is, this is a temporary situation. This is beyond their control. If management does get their mojo back and the company, begins to grow again, then I do believe it would be something you might want to look at. It does offer almost a 4% dividend yield. It does have a lot of debt, but again, debt's not really relative here because debt is their product. So, if I look at it from a standpoint of operating cash flows, I think that, we're not going to be able to see a good picture there either. I don't have any estimate data is what I'm trying to say, but we do see cash flows are significantly covering the company's dividend. So the dividend looks very well protected. The dividend payout ratio, the cash flow payout ratio is about 10%. If I go back to operating earnings here and look at its payout ratio relative to earnings, you'll see that the normal payout ratio for this company has been actually very conservative, if you will, low. It's been, paying out about 20%. Now that is going to balloon to about 71% this year because of this drop in earnings, and that's assuming the company continues to maintain their dividend. But from a standpoint standpoint of turnaround, looking out further into the future, this company looks extremely intriguing at these levels. Now, the next company I'm going to take a look at is the property and casualty insurance company, NMI Holdings. And there was a very interesting article on Seeking Alpha that I happened to notice when I was doing some preliminary work on, these 4 stocks. Because again, I know very little about them. I want to make that clear. These are stocks that look like they'd be interesting to research further. And apparently Mark Palmer at the BTIG Bank said that, there's going to be a big move, or potentially a big move, after some regulatory benefits or announcements that were made on the stock. And they said, that they're going to lift some of the restrictions that they have. So there's a possibility these stocks could do really, really well going forward. So once again, we are seeing a potential weakness this year. That we're looking at 11 current estimates are looking at the analyst estimates. Analysts forecast an 11% drop in earnings this year. Now, by the way, this company was expected to earn over $3 just 3 and 6 months ago. The most recent estimate was $2.90. It's dropped now to $2.33. But then we are seeing forecasts, and there are 12 analysts following this stock, to see 18% growth returning in 2021. Now, if you looked at this as a 15 multiple company, which is normal, by the way, that would be very attractive. Rates of return would be extremely strong. If we looked at it from a normal multiple, which again is the 15 multiple, we have a similar result here. So this would be one that has become very, very cheap, and mostly because of the coronavirus pandemic and what it's done to retail and what it's done to, obviously claims to property and casualty companies. But the valuation is just so compellingly cheap here. I think it's worth taking a closer look at. Anyway, there you have it. 4 kind of very interesting growth stocks, some that really look extremely cheap and extremely attractive. If these guys, get their mojo back, this would be a great time to be buying these growth stocks. If you're a younger investor with, long-term total return ideas, then you might want to take a closer look at these 4. I find them very, very intriguing myself. And, they have reasonable debt levels. The companies are just extremely inexpensive given what's going on in the market. So this could be a speculation/turnaround opportunity. If you like what you saw here, don't forget to subscribe to my YouTube channel. Thanks for watching.